The major part of the risk here is the question of price or market risk, and I've divided this into three different parts. The market risk overall, currency risk, and the most vexing question now is what we call differential risk, what academics call the basis risk. Now, market risk is, as you all know, the risk of the market as a whole falling or rising to the detriment of the owner of the coffee, depending on the type of transaction. Now, in coffee, over time, we have moved over to what we call price to be fixed contracts in general. There are some coffee is still traded on a fixed price basis, but it is a minority. In most transactions, prices are, at the time of the conclusion of the transaction, what is established is a differential, a difference, either positive or negative, in relation to one of the futures exchanges, and this is fixed, and the actual level of the futures exchange will be fixed by each of the two sides of the transaction at a later date. And this obviously reduces the risk to the parties involved considerably, and gives flexibility for each of the two components of the transaction to do their own timing with regard to pricing. Can be difficult especially for the buyer, because he has to finance this on the futures exchanges a lot of the time. Many times the seller fixes the price on the futures exchange at an early date, and the buyer will only fix at a later date, and meanwhile he has to put up with high margin calls and needs a considerable financial capacity. So you can limit this by volume limits and other financial limits also. And currency risk. Now, this is the question of adverse movements in local currency versus the US dollar, which is the standard currency used for coffee pricing on the exchanges. How can you deal with this? Currency futures contracts, forward contracts, these are very sophisticated instruments which are beyond the reach of many of the smaller components of the chain. I just want a couple of examples here. There's some variation between the euro and the dollar, so you can see from a buyer's point of view how you would need to hedge against these movements. But it's even more dramatic in terms of the different origins. And here you have the currency movements since January 2005. Sorry, the header is wrong. Of the currencies of the 4 leading coffee producers. And the lower line, the blue line, is Brazil. You can see that the Brazilian real has revalued almost 40% against the dollar in this period. Excuse me, I'm colorblind, but this red or brown line is Colombia. Also a considerable revalue. Green line is the Indonesian rupee. And on the other side, you can see that the currency of Vietnam has been devaluing against the dollar. So this has to lead to different internal strategies among the producing countries. I'd also like you to note the spike around the end of 2008, early 2009, when the explosion of the world economic crisis and what this did to the currencies of Brazil, Colombia, and Indonesia. And just as a practical example, I recently received the visit of an old friend of mine who is now working with risk management in Brazil. And this is a chart graph he uses when he goes to his clients, showing the differences between the evolution of the Brazilian coffee prices, internal prices, as measured on the São Paulo Futures Exchange, that is the blue line, and the Brazilian exchange rates. So you can see how they move in contrary ways. On the bottom right-hand side, you can see the correlation in the period. It's negative 0.76. So the currency and the prices move in almost totally opposite directions. And some kind of hedge has to be part of your trading strategy in this context. And finally, we get to the most difficult question facing risk management in the coffee world, is the changes in the relations, the differential risk, as we call it, which are the changes in the relations of the price of a specific quality of coffee to that of the market as a whole. And here we do not have any good instruments. As I said before, each quality of coffee has its own characteristics and has its own price on the market. Here you can see the three groups of Arabica coffee, which I briefly explained at the beginning of my presentation, the behavior of their prices since 90 in comparison with the New York Futures Exchange, which is the established Arabica futures market. And you can see overall the variation is low. But in specific circumstances, then the variation starts getting very high. And if you look at the big spike in July 97 around, that is, remember I told you about the Brazilian frost in 94, and then the price effect was prolonged later on in 97. Colombia had some problems with its crop. The stocks were almost exhausted, certified stocks. So we had a big spike in the differentials there. And this has been repeated, but on a much more longer basis in recent months, since mid-2008 onwards. Colombia has been affected by 3 disappointing crops in a row, and you can see how the price of Colombian coffee, the blue line, went up very fast during this period. You can see also that the most readily available substitute for Colombian coffee, which is the red line, the other milds, also with a bit of a lag, also increased. And meanwhile, paradoxically, the green line, the Brazilian naturals, which are Arabicas but are not deliverable against New York, they show a remarkable stability. And this is a paradox which has been exercising the minds of all those involved in the coffee trade. Why can I not hedge the Colombian coffee, the other milds, efficiently when they are deliverable against New York, and Brazilian coffee, which is not deliverable against New York, the relationship is more or less stable, and you can use the exchange efficiently. Now, the big reason is the following. There's no exchange, for futures exchange, to to deal with Brazilian Arabicas. And so they are not tenderable anywhere. They are hedged against New York. You can see here that the blue and the red are the tenderable growths against New York. They have been following steadily, and now New York represents less than 50% of tenderable coffee in the world. So this is something we are looking at. In terms of the Robustas, the variation is much less. You can see it goes from just a positive about half a cent to 11 cents, a much less variation. We are studying this. We have our own little version of FarmD within the ICO. It's called the Consultative Forum on Coffee Sector Finance, and we will hold a meeting in September to look at this question of differentials. Now, just to sum up what I've been going through so far, you can see the different types of risk and what is happening in this current context, and they are all going up.